Bill, I haven't done the 3-month moving average of jobs, but we're not getting the jobs growth we got 10 years ago. Is that a surprise?
No, I don't think so. Certainly not at the levels of unemployment that we're at now, not only in terms of U3, but U6. I think as an economy matures and this recovery is 8, 9, close to 10 years in the making, job growth comes down. So I think it's to be expected. It's a weaker number than the market expected today, but nonetheless, I think it reflects via the work week, via wages that we're on steam for a 2.2% type of real economy going forward, which may not be what the market's expecting, but what I think is going to happen.
Does the tepidness of this, the vectors, the 3-month, the 6-month, the 12-month job formation, and also wage growth, does it adjust what Chair Yellen will confront June 14th?
I don't think it changes much. I do agree that the chair believes in job growth more than anything else, and to the extent that it's lower than the market expected, perhaps, but she's going in June. I think the Fed, Tom, is verklempt, to cite an old Saturday Night Live skit phrase. It wants inflation higher in the real economy, but not necessarily in the financial markets. And so we have not dreaded fear, but concern about financial bubbles in some areas, commercial real estate, and so on. And to be fair, other central banks are really pouring on the coal in terms of the global economy. The ECB and the BOJ, by the way, Tom, now have balance sheets larger than the Fed at $4.5 trillion plus each of them. And so there's a lot of money coming into this global economy, and for the Fed to join in and stop raising the Fed funds level, or even not address what we have in terms of their balance sheet later in the year, I think would be a mistake.
A little coffee talk here with Bill Gross of Janus Henderson here on Jobs Day. Bill, let me ask you, what happens when the Fed begins unwinding this balance sheet? What's that going to mean for term premium?
Well, it depends on how fast, right, David? And we're talking about not only treasuries but mortgages, because they're in that pot too. At the moment, the forecasts are, the private forecasts are for like $10 to $15 billion a month, which makes an inroad in terms of reducing the balance sheet, but certainly at a very slow pace. I think ultimately, though, to answer your question, that the term premium for 5 to 10 to 30-year treasuries, which are a significant part of that balance sheet, basically has to increase. The term premium as, not only forecast, but put into evidence by several district Fed Reserve banks suggested that 75 basis points lower, was the net of the $4 trillion addition that we've seen, prior to the past few years. And so you would have to expect the term premium to go up. Does it go back up by 75 basis points? I don't think so, but certainly higher over the short term.
David Gura, pick up the question here, but we got to do a data check for radio and television right now, because this is really remarkable. 2.18% on the 10-year yield. The 30-year bond is 17 basis points in from 3%. That is a huge deal. And over on the Kareem, get over here right now on Bloomberg Television. For those of you in radio, this is a wow statistic. Bill Gross is minting money this morning. The 2-10 spread is broken under 90 basis points. Gross may have to cancel the interview. David, jump in with Bill while I continue to look at the spread market.
Bill, let me ask you, you're a global investor. We have seen changes to geopolitics here over the last 24 hours and certainly over the last week plus. How does a different role for the U.S. in the world change your outlook and your positioning?
See, I think it's significant. I don't think the market thinks it's significant, because the stocks blew by that news, yesterday. But let's look at it this way in terms of the Paris Accord and our absence, at least in terms of philosophical absence. It's destructive from my point of view for equities, because equities are long-term cash flow dependent, and what we're talking about here in terms of global warming going higher is the increase in and long-term liabilities. And so ultimately, stocks have to be affected by the potential for the expense, the liability, to contain global warming if it goes much higher.
Okay, here's the heart of the matter. Kareem, don't come over here again, Kareem. Come on, I make the rules. This chart was to Kaplan of Dallas. This is the vector of inflation, and Bill Gross has been dead on that we're not right, that core PC inflation is rolling over. Bill, with this jobs report and with the 2-10 spread under 90 beeps, with yields coming in, weaker dollar, would you say even more so now that inflation is just not part of the debate, and that gives Janet Yellen cover to lengthen out her path to a normal yield policy?
Well, I'm not sure I understood the two parts of that question, but I think what it does for Janet Yellen is allow her to to keep the Fed funds level, the long-term neutral Fed funds rate at a lower level than she would have previously. There is a contentious debate among Fed officials as to what R-star, which is really the real long-term Fed funds rate, what it is, and at the moment it appears that it's less than 0, and I think Janet Yellen will keep on keeping on, and as long as financial markets in some areas of the economy do not show bubblish types of characteristics.
How are you adjusting your portfolio at Janus Henderson? I mean, we have seen a Bill Gross economy over the last 2 months, I would suggest, where it's been a little bit disappointing from the enthusiasm. How have you adjusted your portfolio?
Well, let's look at it this way from all asset classes, Tom. So we know volatility is low. We know about the VIX. It's less than 10, which is historically low. We're not so, necessarily informed on bond volatility, but it's historically low as well. And so when you have volatility in the two major markets at low levels, you certainly don't want to sell that volatility. And the way investors basically assume risk and sell volatility is to buy stocks, to buy duration, to buy high-yield bonds at relatively low spreads. In other words, they move into markets that have low risk premiums when they should move into markets that have high risk premiums. So this is definitely a market, not just with stocks, but with bonds and other asset classes, where an investor has to be careful because of the low volatility that's embedded into the market.